Welcome back to Fast Market on the Schwab Network. I'm Diane King Hall alongside Kevin Hinks over at the CVO. Time now for our cash tag segment. For that, we want to bring in our next guest, and that is Landon Swan, co-founder of LikeFolio. Today, we're taking a look at Deckers, the parent company of Hoka and Uggs. Okay, these shares have had a difficult year this year. They've had some tariff risk. Today, they're actually higher heading into their earnings. What does your data show you about where sentiment is as it relates to the names that fall under Deckers brand, Landon?
Sure. Yeah, they've got several names. The two that you mentioned are the two key ones. I think Hoka is a massive part of their percentage. It used to be all Ugg boots. Now Hoka's taken the number one spot. But those two brands are actually doing very well. They're up, I think, 20, and Uggs is up 20% year over year. Hoka's up 14% year over year with our data. Now that's after last quarter they guided for about 10% gain in each. So we think they're doing better than they guided for last quarter. And you're right, this has been a tough year to be an investor in Deckers Outdoors. And I think it's somewhat unjustified when you look at the data. I mean, even if you look at just the hard numbers from last quarter, I mean, they were $105 a share heading into the earnings. They had revenue that beat by 17% year over year. Earnings per share that went 24% above year over year. Their margins are 56%. Everything's doing really well. International sales are up 50%. And then the stock jumps up and, jumps up to, I think, 116. But since then, it's sold back off to 103. So it's a little bit below where it was last quarter, and they posted really good results. And their PE ratio is 16, very low, much lower than a lot of their competitors. And if you're a technical person, that looks like a support to me, right? I mean, I'm not huge into that kind of stuff, but we're right above 100, and it just can't seem to fall below 100 as it moves into an earnings report where our data says it's doing better than they guided for, and everything's looking pretty strong. And when you compare them to their competitors, it's really crazy. I mean, you've got Adidas, Crocs, Nike, they're all negative on a year-over-year basis with our data, but Deckers Outdoors is positive at plus 15%. They're doing really well, and there's a lot of reasons that they're doing well. Hoka primarily is the one. That brand is really resonating, but also Uggs is doing a fantastic job with their 365 strategy. This used to be just purely winter boots, and now it's less seasonal. It's still very seasonal, but it's less seasonal, and they're getting sales throughout the year. But you can see here, Deckers Outdoors versus the competition, they're the clear winner. They're doing a lot of things right, and frankly, I think that they're pretty undervalued heading into this earnings report, similar to how they were last earnings report. They jumped up and now they're back to where they were. I think that people have amnesia of what happened, but here we are right above support with strong data and a falling stock price. So this is one of those divergence opportunities that LikeFolio that we love to see.
Landon, they have a total of 6 brands, but Ugg and Hoka make up 95% of their revenue. So that's a great 2 really stellar brands. One article I read from an analyst said he thinks some of the sell-off was due to their lack of guidance going forward. And he thinks if they simply reinstate and give guidance that's solid, he thinks the stock could really rally off this. But your data shows strength in these brands, despite the stock just lingering down here at these low levels. I guess my question to you, Landon, is: are we missing something? Do they need some of these other brands to step up and contribute? Can this stock rally off 2 brands doing incredibly well? Because I don't think Hoka's dropped off at all. You don't have On Holdings on your chart. Are they hurting Hoka? Are they a serious contender? Because Hoka seems like they're a serious player, even against brands like Nike. What's holding the stock back, Landon?
Yeah, I would say On Holdings is definitely a big competitor. That's one that we're very bullish on at LikeFolio. That's an omission. Should have had that one on there. They'd be positive as well. It'd be Deckers and On Holding, probably On Holding in the number one spot, frankly. But compared to the rest, Deckers is doing really well. And to answer your question, yes, they can absolutely crush it with just 2 brands. They did fairly well with, now they've got Hoka. It's taken over, and they're doing very well with both of those. Hoka is, I think, one of the fastest growing footwear brands there is. I mean, it is doing extremely well, and they've taken a lot of market share from the competition. And really, I think this is what we're seeing is Nike kind of opening the door for all of its competition. They have fallen off so much. They are at the bottom of that chart that we posted a little while ago at -18. They just completely dropped the ball, and a lot of companies are glad to jump in and take that spot. On Cloud definitely being one, but Deckers Outdoors as well. And so when you look at all the things that they're doing right, they've got the two brands that are surging. They're moved to the direct-to-consumer model, which is now 40% of their sales. So their margins are defensible with even more promotion. They talked about that last quarter. They're increasing their promotion, which I think cut their margins by about a point. But because of direct-to-consumer, it was only 1 point. So they're doing great there. They've also moved away from China. I think 20% now of their manufacturing is either in Vietnam or Cambodia. So they're reducing their tariff risk quite a bit. And just overall, this is a very strong company. They have no long-term debt. They got $1 billion in cash. And, they're sitting at this low level again, where they were here a quarter ago, 2 points higher than this. They're at 105. They jumped to 116, ran up to 121 throughout the day. And then since then, after that earnings report, they've drifted back off to 103. So, it's basically like last quarter all over again, except for I think the data for these two brands and the company overall is actually stronger heading into this earnings report than it was last quarter. So, if you can't tell, we're pretty bullish going into this one. On our earnings score, we've got a +50 on it, which is pretty bullish. And you can see the divergence here. The solid line, the darker line, is the web traffic score. You can see it's a fairly good leading indicator. The stock price has tanked significantly from a year ago, from the seasonal high there. And it's starting to move up significantly, starting to get that nice upward trend, whereas the stock is just kind of hanging around 103, just waiting for some good news. And I think the good news is coming this afternoon.
So, Landon, let me ask you this. I think you make a great perspective, and what Kevin said is true. When you look around, the shoes that you see, the sneakers that you see on people's feet are typically On or Hoka, right? Revenue is expected to top $1.4 billion, right? But that's still down on a year-over-year basis for Deckers. I wonder if one of the challenges is just the price for consumers, right? The macro picture, if that's part of the challenge. Do you have anything on that?
Yeah, so what we're seeing in the data and the sentiment when we dive into consumer sentiment is we're seeing a lot of what you might call a K-shaped recovery, where it's the consumers that are kind of above the line, that are doing well, don't feel a lot of this strain, inflation, or slower economy, whereas the lower part of the economy, those consumers are feeling it quite a bit. And so if you've got a brand that is based on price, that's the big value that you're pitching, you're going to struggle. That's what we're seeing with our data. You see it in restaurants all over the place with fast food versus fast casual. It keeps shifting around who's got the lowest price, best value. But then when you move into high quality items where the price isn't nearly as important, but it's all about the quality, and that's where you're getting into the Hokas, then it's great for the company. Consumers don't really care that much because those consumers aren't strained. And so right now it's great for a company to be selling to consumers that are doing well, and about, it's a split. It's half the country's doing great and half the country's not. And I think that gap is continuing to widen. But right now, I think Deckers Outdoors is on the wrong side. Is on the correct side of that split. And so they're selling to the customers that really care about value, and price tag comes second in their mind.
All right, thank you, Landon. That is Landon Swan, co-founder of LikeFolio, with a look across Deckers, which has set to report its earnings later today. For the trading perspective on Deckers, I want to kick it over to Tom.